What's up, Peakbot Nation? My name is Ben Colabella. I'm one of the co-founders of Peakbot, and we are going to learn a little bit about how we trade our trend spread strategy. Now, the trend spread strategy can be automated through our automation services. However, if you are looking to trade it manually, that's what we'll be talking about right now, and the mechanics of it, how all of it works, and the different resources that are available for you to use. So with that said, I want to start by explaining that the trend spread strategy it's a neutral, it's a bearish, and a bullish strategy. So this strategy could be traded in any type of market environment. Now, of course, that doesn't mean that we're always going to win, right? We actually have the same statistical odds of winning for every setup that we get ourselves into. But we do want to give ourselves a bit of an edge when thinking about how we want to set up these spreads. And before we get into the actual strategy, I do want to mention that as a part of this strategy and as included in the information that we provide in our watch lists, we are determining a trend direction. And the way that we do that at Peakbot, and there's many ways to do this, this is just the method that we've chosen at Peakbot, is we're using the 67-day EMA. And actually, below this video, we'll share the exact formula that we use to determine if the trend is bearish, if it's neutral, or if it's bullish. And depending on that trend direction it's going to determine what type of spread we're going to set up. Now, we are setting up credit spreads, but if the trend is bullish, we will be setting up a put credit spread. If the trend's bearish, we'll be setting up a call credit spread. If the trend is neutral, and depending when you watch this video, we're either going to be selling an iron condor or sitting out that particular trade. Now, we could profit from a put credit spread or a call credit spread in a neutral market. Sometimes it's more beneficial to trade iron condors, and when it is, we will. And if it's not beneficial, then we'll just sit on the sideline. That's totally fine, right? At the end of the day, if you are trading this manually, we're just giving you all this information so that way you've got everything in hand to make these decisions yourself. We want to make sure that you're equipped with the right information to make educated decisions trading. Again, not financial advice. We're not financial advisors, but we are data providers in this sense. So when thinking about, again, how Peakbot trades our trend spread strategy, which trend spread, credit spread, I'm using those interchangeably. We're selling weekly options here. So ideally, we enter on a Friday. And we enter on a Friday and we sell a credit spread for the Friday for next week or next week's expiration. There will be times that the market's closed on Fridays, so the next week's expiration will be on a Thursday. If we don't get in on Fridays, then we'll sell our spreads on Mondays. And this is how we set it up in the automation as well. If we don't get in on Mondays, we can get in on Tuesdays. If we don't get in on Tuesdays, then by the time Wednesday rolls around for this week's expiration, the amount of premium you would be earning on this trade kind of diminishes to the point where, you know what, let's just sit this week out. The risk might not be worth the reward here in this case. So when we are setting up our credit spreads, no matter if we're setting up a put credit spread or a call credit spread, if the trend's bearish, bullish, neutral, whatever that 67-day EMA is telling us, we're going to be selling the 30 delta and buying the 10 delta. And by doing that, the size of the spread is going to vary. It's going to vary due to a number of different factors, like what is the overall stock price at. Higher price stocks are just naturally going to have wider spreads. And what's the level of volatility like for that particular ticker? The higher the volatility, the wider that spread is going to be, and the higher your max loss is going to be. But the nice thing about setting these spreads at a set delta, and we're trading the 30 delta, we're selling the 30 delta. That gives us statistically about a 70% chance of winning. And what that 30 delta means, and you can see there's a relationship between that 30, that 70, and the 100, a 100. And what it's basically stating is that the 30 delta is saying there's a 30%-ish chance that the stock price is going to drop below this strike. Now, as option sellers, that means it's in the money. We don't want to be in the money as an option seller. We want to be out of the money. So the exact opposite of that 30 is our 70% that the stock price will be out of the money, or that contract will be out of the money. The stock price will finish, either above that sold put or below that sold call. And that, again, gives us statistically about a 70% chance of winning these trades. I'm going to share this diagram. We are using a diagram on Tasty Live. So Tasty Trade, one of our broker partners, they provide a ton of great educational resources. We can quickly talk through an example of what a put credit spread looks like. They do call it a vertical put credit spread. Same thing. You'll hear vertical spreads, just credit spreads. All of these terms are interchangeable here. So in this diagram, let's assume, I guess we are assuming that the stock price is $120. Now, we are also assuming, again, we're selling a put credit spread. So we're assuming that we're selling the 110 strike as a put. And then we are buying the $90 strike. So that's setting up a spread of roughly $20. So we take that 110, we minus that $90 from it. That's how we get to our $20 spread. The spread's important because this also roughly equates to the amount of capital you'll need in your account to actually place the trade. So if you're thinking about your budget and you're thinking about, how many spreads can I fit into my account for this week, it's important to take the spread into consideration to perform that calculation. If you are automating with PeakBot, we do that calculation for you. If you're trading this manually, unfortunately, can't do that because obviously you could set the spread however you want to set the spread. We don't have an automation doing that on your behalf. So in this particular example, again, the stock price is trading at around $120. We might be selling the 110 strike and then buying the $90 strike. And that's giving us a $20 spread, which means as well that our maximum loss here is whatever that, so whatever the premium is, plus the spread. So the spread, again, $20, that's a $2,000 potential loss. You have to add back in the premium you would earn. And it looks like, there might be $800 in premium earned on this trade. That's represented by this green shaded area. And again, this is just an example from Tasty Trade, not necessarily one-for-one with how PeakBot trades this strategy. But there's, again, the $20 spread, $2,000 loss. Then you have to subtract out the $800 in premium you would earn from this. And that gets you to your essentially $1,200 actual loss. And we can see that represented by the $1,200 here. So the max we could win on this is $800. The most we could lose on this is $1,200. And again, the chances of us winning this entire $800 would be set at around 70%. Again, the way that PeakBot is trading this strategy. And, going back to the deltas that we're selling and we're buying here, we're selling the 30, we're buying the 10. So that 10 delta essentially means that we've only got about a 10% chance of that max loss actually happens. So 90% of the time, that max loss actually isn't going to take place. So that there's a 70% chance that $800 will take place in this example, 10% chance this $1,200 loss will take place in this example. And then there's this 20% in between where we could have a partial loss or a partial gain. So that's certainly something that can happen. So again, we're trading this strategy weekly. Positions will expire on Fridays typically. And then on Fridays, we will roll into the next week. So that means there's no assignments. We're not getting assigned any shares on this strategy. We're trying to avoid that. There are instances where you could get assigned if the stock is paying out a dividend and the X date comes and there's just an unusual number of people exercising their options. Your sold strike might get called away. And you might be forced to, in that case, sell shares. You might end up in a short position so that way other people can get their shares. But for the most part, we are avoiding assignments by rolling these positions on Friday. So if you are in an open position, and again, PeakBot will do this will do this automated for you, or our automations will handle this, the trade placement for you, but you can do this manually. On Fridays, what we're going to do is we're going to close out of the current week's position. And then we're going to open up next week's position. And the information provided on our watch list will let you know, hey, are we closing this week's position out? In this example, we were trading a put credit spread. If the trend direction has changed, our watch list is going to tell you, hey, we're seeing a change in direction. We actually think this is a bearish strategy now. We're going to say, we want to close out that put credit spread, and we're going to want to open a call credit spread. So again, bullish equals put credit spread, bearish equals call credit spread, neutral could sell an iron condor, could sit out. All this information is going to be in the watch list, in our alerts section, or if you're subscribed to our automations, the watch list will also have this information, though you don't need to worry about it because the automations will do it for you. But if you are trading manually, we're going to tell you the direction. We're going to tell you your max loss. We're going to tell you your max gain. We're going to tell you the strikes that you should sell and buy, and of course the amount you should set your limit orders at. So good luck trading this strategy. This is one of my favorite strategies, trading these spreads. I like to think that we give ourselves a little bit of an edge by figuring out or trying to determine what the trend is. Again, just to recap, we are selling weekly contracts here, selling the 30 delta, buying the 10 delta. We're going to be selling put or credit spreads varying based on the trend direction. Overall win rate of about 70%. The capital you need is a lot smaller than you need for the wheel. You only need the size of the spread, roughly. No assignments. And again, we just keep rolling these positions on Friday. So collecting premium week after week after week. So any questions on the trend spread strategy, please feel free to use the chat feature on our website, and we'll get back to you as quickly as we can. But happy trading. Feel free to automate this. Happy to get you on our automation platform, and we will see you at the peak.